Yeah, I mean, I think you were actually hitting on one of the critical elements, I think, that has influenced options volume last year and this year. You were talking a bit about the Reddit rebellion, basically the meme stocks, basically a big increase in self-directed investors using platforms like Robinhood have fueled a huge increase in the volume of options traded. So if we take a look over the entirety of 2021, the average trading volume ended up at the end of the year at about 37.5 million contracts traded per day. And that was basically steady growth that we saw throughout the year. To put things in perspective, that's about 3.75 billion shares equivalent. And that's about a 30% year-on-year increase versus 2020, which itself saw a very big increase in volumes, partially because of the pandemic. And obviously, there was a lot of hedging activity associated with that. But that was about a 35% year-on-year increase over 2019. So as a vehicle, basically, for people to put their capital to work in either a speculative way or for hedging or for getting income, this is one of the fastest growing areas and one of the fastest years that I've seen since I've been in the business.
Oh, I think it was a record year for options activity, Mike. But are these retail traders especially playing a losing game, buying just plain puts and calls, where some of the more sophisticated institutional investors usually do complex strategies around options?
Yeah, I think that's a really good point. But, you know, one of the things that we have seen in the past when we've seen these big increases in volumes is basically that the newest market participants educate themselves very quickly. And I think the resources basically that are available to investors now to do that is higher than it has ever been. These are people that have been sitting at their desks and they're learning in real time what to do and what not to do. You know, one of the things, obviously, that was a benefit to them, if you buy a call option, typically you are going to be spending less capital than you would be to buy a like amount of the underlying shares. And so you can define your risk that way. But of course, as you point out, options decay. And, you know, what you need to do is try to look for spreads. And we are seeing increasing amounts of spread trading as well. So I think what's happening is they're getting into the market and then they're getting educated very quickly.
So if you think the market is set for a correction or a bumpy period next year around Fed interest rate increases or withdrawal of fiscal stimulus, what's the best way to hedge yourself in the options market?
Yeah, so I think it's a good question to ask, because one of the things that the options market permits us to do is to see where market participants, and I'm talking about all market participants, not just retail, but institutional as well, we can see where they think there might be bumps in the road, whether they have positive sentiment, negative sentiment. The interesting thing to me is that, of course, we've obviously had this big run up in equities for a couple consecutive years now, and people feel like we might be reaching some kind of a top. They're concerned about rising interest rates. But take a look at the VIX index at 17 or so. While maybe not as low as it's ever been, that doesn't signal a great deal of concern. Now, we are seeing some increases in implied volatility to take place between regular way expiration on January 21st and the week ending January 28th. And why is that? That's the week that the FOMC meeting is going to be taking place. So the options markets are expecting a little bit more volatility around that period, but not huge. So I have to say there's relative complacency here. Where they're the most bullish remains technology, energy, and then trailing financials. So that doesn't feel like very defensive positioning. Where we are seeing defensive positioning is out in March. And that's where we see puts basically at much higher premiums than we do for calls. So, for example, if you see a 5% out of the money call, you could sell that or buy it, I should say, and you could finance it by selling a 15% out of the money put. So